Good morning, good afternoon, and good evening, everyone, wherever you are in the world, and welcome, warm welcome to our webinar, Recalibrating Europe's Hydrogen Strategy to Support the Clean Industrial Deal. This webinar is hosted by RMI, and thank you for joining us to talk about hydrogen's role in deep industrial decarbonization across Europe. My name is Alexei Tatarenko. I will introduce myself momentarily. In the meanwhile, we'll give everyone a couple of minutes to join. And please note, this webinar is being recorded and will be posted on RMI's event page within 24 hours of this event, along with other related resources. During the webinar, please feel free to drop any questions that you have into the Q&A function on your screen, and we will get to as many as we can during a live Q&A session at the end of the webinar. The webinar will be an hour and 15 minutes long. We will spend around 10 minutes on presenting the report and the key findings, and then we will go to the interactive panel with the four outstanding panelists whom we have here with us. So thank you again for joining us, and we will get started soon. All right, I think we've got a quorum here. Good morning, good afternoon, and good evening, everyone, wherever you are in the world. Welcome to our webinar, Recalibrating Europe's Hydrogen Strategy to Support the Clean Industrial Deal. This webinar is hosted by RMI. Thank you for joining us to talk about hydrogen role in deep industrial decarbonization across Europe. My name is Alexei Tatarenko, and I am the Hydrogen Senior Principal within the Climate Aligned Industry Program at RMI. During the webinar, please feel free to drop any questions that you have into the Q&A function on your screen, and we will get to as many as we can during a live Q&A. We'll start with a presentation that I am determined to keep short and sweet because the main value will be in the interactive discussion that we will start in about 13 minutes. This webinar will be an hour and 15 minutes long. So let me start with the key findings of the report. The report is called The Case for Recalibrating Europe's Hydrogen Strategy, and it will be followed by discussion with today's panelists. Before I dive in, I would just mention that RMI is an independent, non-partisan, non-profit organization that transforms global energy systems through market-driven solutions to secure a clean, prosperous, zero-carbon future for all. RMI has 700 experts working on 4 continents, including hydrogen teams in the United States, Europe, India, and China, that focus on heavy industry and transportation sectors. So we'll be building up on that global expertise and zooming in into Europe today. So let's start with the presentation. First, I would like to outline very briefly why did we feel that this report is timely to pull together, and the main reason for that is that, as you probably know, back in 2020, about 5 years ago, the European Union set ambitious goals through the first hydrogen strategy. As we all know, pursuing dynamic strategies is important because the external environment, markets, technologies, geopolitics, climate, consumer behavior is constantly changing, right? So having a static strategy is never a good idea, as you risk it to become outdated fairly quickly. This is very true for hydrogen world, which is dynamic and fast changing. Kickstarting a nascent sector is a difficult task on its own, but in addition, the European Union tackles parallel challenges of energy security, energy affordability, trade interdependence, industrial policy, with now Clean Industrial Deal coming out as a strong response to that particular challenge. So things have changed, and this report was meant to take a stock of where the European Union stands with its strategy implementation and make a case for course correction in several areas. It was not meant to provide all the answers, maybe our panelists will, but to set the stage for building strategic alignment among policymakers, industry, and civil society to start the dialogue. So the 5 areas that we will be looking at and talking about today is, first one is balancing supply and demand, particularly with a focus on demand, because this is where it all starts. Second, related to that, is we will talk about priority sectors that we need to focus on. Third area is about balancing carrots and sticks, how we drive offtake. Fourth area is around aligning public funding to policy objectives, as we see a challenge there. And finally, the fifth area is about how to guide the industry with a stable regulatory environment. As we move to the next slide, talking about demand, well, demand is likely to be much less than originally anticipated. This is clear. We estimated demand in this report to be somewhere between 2.2 to 2.8 million tons per annum from mandated policies, or from mandates that are coming from policies, with some upside and potential to reach 7 million tons per annum by 2030, and we are talking about 2030 timeline here, if funding is increased to release our accelerated transition scenario. Current consumers of hydrogen, where mandates will have the biggest impact, are refining industry and fertilizers. These 2 industries and chemicals will drive demand from mandates. In the accelerated transition scenario, we see a much bigger role to play for the sectors such as steel, shipping, and aviation that have the potential to drive demand outside of the mandates, and therefore we would like to focus on those sectors. We go to the next slide. Well, next slide is really showing the key sectors, and I should state straight away that given the limited amounts of funds that the policymakers have at their disposal, and hydrogen production capabilities as well, it is critical that hydrogen is targeted towards sectors that really need it to decarbonize. And in RMI's view, those sectors are heavy industry and heavy transportation sectors. We believe that Swiss knife metaphor used by some in the industry before hasn't been helpful and led to a peanut butter strategy in many instances, not only in Europe, and was a distraction. Public funding is a scarce resource, and we need to operate with scalpel intervention and focus targeted support on the right priority sectors. So this is really the main message on this slide. If you go to the next one, the key message here is that both subsidies and mandates are needed, in our review, to push forward the renewable hydrogen industry, given that mandates have adequate penalties attached to them. Targeted distribution is key to enable the sectors mentioned previously. We really need to get targeted and use that scalpel, sector by sector, and find a way to have tailored mechanisms to unlock demand in the mentioned sectors. And in our view, a carrot-only approach would lead to investor uncertainty. There's a simple logical test. If policymakers believe there are enough of carrots, why wouldn't they introduce the sticks attached to carrots? The next slide is really showing the state of play as we've done analysis with deployment of funds. And I should say that despite the very high level of funds committed at the level of 21.4 billion euros from the Commission and member states, our analysis has shown that only a fraction of those public funds has been dispersed, which is a challenge, and I think will be an interesting topic for today's discussion. How do we accelerate that? Because public funding is very essential to unlock private capital. We've tried to make a comprehensive snapshot here, but we might have missed some pockets, particularly at the member state level. So again, it will be good to calibrate, the exact numbers during today's discussion. So the key question is really how to move funds from the category of committed to dispersed. And according to our analysis, if you were to pursue the accelerated transition scenario, 45 billion of public funding could unlock 275 billion in private capital expenditures, which is not a bad leverage effect. It's almost 7x. We could go to, I believe, my last slide. This is really about regulatory environment, and the key message in the report is that reopening the RFNBO delegated acts will probably delay investment decisions even further and create further uncertainty. So we think that it's not wise to do that. But more importantly, we believe that it's crucial for the policymakers in particular, but for all of us collectively to start, walking the talk and focus on implementation. So in that regard, the transposition of the key Renewable Energy Directive 3 mandates by member states into national regulatory frameworks this month, as you know, is a deadline, is an excellent, example of what can be done to make goals tangible. And this is going to be crucial for building and maintaining stable regulatory environment and confidence in the market. So with that, I will finish my short overview and move into the meaty part of our discussion today, to our distinguished panel, and will introduce the panelists. With us today, we have 4 esteemed experts on hydrogen, whose expertise is ranging from the non-profit space. We've got RMI CEO John Kreitz here with us today, to industry. We have 2 industry representatives, and government. We've got Lucas, who is representing Directorate General for Energy of the European Commission. And I'll start with introduction of Lucas. So Lucas Wernert is Hydrogen Policy Lead in the Directorate General for Energy of the European Commission. In 2023 and 2024, he was European Union Fellow in the Institute for Transportation Studies in the University of California, Davis, focusing on the EU-US hydrogen policy. And before that, he led the establishment of the first European Union list of priority hydrogen infrastructure projects of common interest, projects of mutual interest, and held various roles in the Commission. Next, I'll go to John Kreitz. Is our CEO of RMI, and internationally recognized leader on global energy issues. Trained as an engineer in energy and aviation and a former partner in sustainability at McKinsey, joined RMI as a senior leader about 13 years ago and has been serving as CEO for the past 3 years. Welcome, John. Next, I will move to Roland Bahn, who is the CEO of Topsoe, where he has led the company since 2020, with a clear focus on establishing Topsoe as a leader in technologies and solutions for the energy transition. Topsoe offers world-leading solutions for transforming renewable resources into fuels and chemicals, and provides technologies needed to produce low-carbon fuels and chemicals. And last but not least, I will go to Anna Cuevas, who is the Chief Hydrogen Officer at EDP, leading renewable hydrogen business of EDP's group at the global level. Anna is also the co-chair of the Renewable Hydrogen Coalition, an established voice of a high-level and interdisciplinary network of organizations dedicated to making Europe, the global leader in renewable hydrogen solutions. Anna will be double hatting today and addressing some questions in her capacity of being Chief Hydrogen Officer at EDP, and some questions she can, I believe, speak on behalf of the Renewable Hydrogen Coalition. With that, we can dive into the panel and start the discussion. Exciting. So my first question will be to Lucas. With 2025 marking 5 years since the European Union hydrogen strategy was released, and we are now halfway into 2030, how does the Commission see the current state of play and role of hydrogen in supporting the clean industrial deal? Give us your state of the union, Lucas, please. The floor is yours.
Thank you very much, Oleksiy. Can all hear me well? Very good. Good morning, good afternoon, good evening, everyone. Thank you very much. And diving immediately into the answer to your question, let me first thank you for the report. I think it has very relevant findings and seems overall very sensible. And then turning to hydrogen, 5 years after the adoption of our strategy in 2020, it's clear that it remains for us a key element of our decarbonization strategy for hard-to-abate sectors where electrification is not suitable. And to give you an idea of where we see it going, in our modeling, we see hydrogen occupying 10% of final energy consumption in 2050. Obviously, decarbonized hydrogen with a focus on renewable. Where do we stand today? We think that we have made important progress since 2020. Back then, we basically had no policy framework. Now we have the most advanced framework in the world. There are still small parts to be completed. And for sure, the most important thing now is to implement it and to make it work. And what we like to say also is that we have put in place a policy framework that covers the whole value chain from production or transport to the offtake side, together with flanking measures, both at EU and member states level. We see major progress on the side of the market and the infrastructure rules, including permitting. We've put in place clear trans-European infrastructure priorities, and we see a number of member states now implementing their hydrogen networks and putting in place a coordinated planning. We have most major markets now with hydrogen strategies and targets, and we also have worldwide the strongest sticks, to use your language, when it comes to the RED III quotas for industry and transport, and also in aviation and maritime transport. 21st of May is an important date indeed, when the Renewable Energy Directive targets will have to be implemented by member states, and we're working very hard with them on that. Next year, August, will be the date for implementing the market and infrastructure rules. When it comes to the flanking measures, we've mobilized significant funds. I saw the figures that you quoted on your slide. We like to refer to 18 billion EU funds mobilized in the current budgeting period, plus the Commission approved not less than 39 billion euro for hydrogen projects only, and 37 for projects where hydrogen is competing with other energy carriers over the last years. We have, just to quote one of the important European support projects, the European Hydrogen Bank second auction underway, and the third one will be coming. Now, where do we stand on the ground? Well, I think we all agree that we would have expected the hydrogen sector to develop faster, to see costs going down quicker. But nevertheless, if you, for example, take the International Energy Agency project database, we are around 300 megawatt of production capacity of electrolytic hydrogen in the EU. We have around 4 gigawatt of projects under development with already passed FID or construction within our borders. And we expect the EU targets, you quoted a figure above 2 million tons. We expect them to trigger by 2030, 3.4 million tons of RFMBO demand. But based on that it's clear that we will need a massive increase of electrolyzer capacity and also growth in binding offtake. And to close, let me also zoom into the Clean Industrial Deal, which confirms the role of hydrogen as a pillar of decarbonization. It, if you want, refocuses or sort of puts completes the existing framework with a couple of additional measures. Notably, lead markets will be an important priority for the Commission to boost the demand for decarbonized products through public procurement. There will also be work on a voluntary carbon intensity label with the steel sector as the first focus area. There will be a new state aid framework that will also benefit hydrogen projects. From a DG Energy side, we are about to kick off a clean hydrogen mechanism that will connect demand and supply by informing also projects of rounds in which they can offer or request offers for production. And that will then also link up with infrastructure and financing developments. My colleagues are about to finalize the Delegated Act on low carbon hydrogen in the next weeks, we hope, if things go well. And finally, I've already referred to the European Hydrogen Bank. We are also kicking off an industrial decarbonization bank to support industry in its decarbonization efforts with a budget of not less than 100 billion euro that could also benefit hydrogen projects. And to close, you spoke about regulatory certainty as an important element. For us, regulatory certainty is indeed very important, at the same time as staying in dialogue with the sector and understanding what's working better and what's more challenging. So we've just kicked off a comprehensive study on the workings of the rules for renewable fuels of non-biological origins, the delegated acts. And we will use this study, including a number of interviews with project promoters to really understand what works better, what works worse, and will inform the review of the Delegated Act by 2028. So in a nutshell, we've put in place a framework. Now let's deliver it together and make it work. Thank you.
And thank you, Lucas. I think your review just demonstrated how comprehensive that framework is and how multidimensional it is, right? I would go next to John, and we will stay macro, but we'll step maybe a little bit back here and place EU into the global context. John, if you could help us with that. I think in many ways, the EU has trailblazed the way globally in creating the policy framework that Lucas just talked about. And that framework, of course, supports hydrogen industry development and to a larger extent sets up the block to decarbonize its hard to abate sectors, both on industry and transportation side. But how do you see Europe's role in the global hydrogen market evolving given current geopolitical and geoeconomical challenges and realities that we live in? Please, John.
Yeah, thank you, Alexei. And Lucas, thank you for joining us and for that overview and for your leadership on helping design and develop policies here for hydrogen. Anna and Roland, thanks for joining as well. Look forward to your comments and interactions here. You know, as was evident from your comments, Alexei, we've taken a really pragmatic approach at RMI to the state of hydrogen development in key markets. I'll get to Europe, but let me start with some other markets. We've issued a similar report for the United States called Made in America for America about the sector there. We're about ready to publish one in India as well, and we have a team that has been working intensively in China for many years right now, and certainly understand the state of the market there. I think what we see in the United States is that the key to the US's competitiveness on a global level is really building a domestic market and maintaining the stimulus provided by the Inflation Reduction Act. That really an export-oriented strategy alone, just based on a natural gas pathway, isn't going to provide enough capacity and enough liftoff to achieve global competitiveness, right? And so the focus for the US has to be on building a robust domestic market, because that's going to be foundational to any export ambitions for the country. You know, if I shift over China understands this very well and is benefiting from the strong foundation of renewables. It has a huge industrial market, and it has really the global leading domestic electrolyzer manufacturing capacity. And it's really focused on deployment to get the muscles, kind of in place and built up that allow it to move quickly on this front. So we see China, kind of in a deployment mode where that's the mantra right now, very much driven by government, I would say, support and encouragement along the way, with fewer formal policies driving it. India, kind of rising quickly, but in a mode right now where the hydrogen, kind of ambition is intact, where it has, a foundational hydrogen policy that's starting to nucleate individual industrial projects especially around ports to begin with, but also fertilizer and other areas starting to move forward. But it's more in the embryonic stage relative to others here. The EU, is I would say, in a leadership role, and confirm what you've stated there, Lucas. When we look at the amount of domestic production support, the offtake alignment, the midstream infrastructure, the import focus, all put Europe in a position where it has a comprehensive set of levers that it's pulling to try and nucleate this industry. I will say it also, though, Europe's experience points to just how difficult it is to kickstart an early industry. When you've got, all the issues of energy security and energy affordability, trade independence, and even deindustrialization all fitting in, that when you're juggling these geopolitical and economic considerations while maintaining or trying to build the Paris-aligned regulatory frameworks, it's not an easy task, right? I think the Clean Industrial Deal addresses the current challenges, and its focus on key industrial sectors, and in particular pulling in steel and chemicals, that it really shows that you can start to recalibrate and build up hydrogen strategies that meet us today here in 2025 and start to build momentum toward 2030. I think this systematic and comprehensive regulatory approach over the last 5 years has really provides the platform, for continued global leadership for Europe going forward. There are some headwinds for sure, but Europe right now is the region I think that will set the global pace here, and it's important for kind of a joint industrial and policy landscape to evolve quickly here to spur this forward.
Thank you, John, for this view on the world and what's happening globally here in the industry, at least in the key regions. With that, we will transition to Anna. And Anna, the first question that I will have for you will be in your capacity as a co-chair for the Renewable Hydrogen Coalition, that I believe you co-chair jointly with a representative from Topsoe this year. So Lucas talked about RFNBO and targets and gave the number in the report. We've got a range between 2.2 to 2.8 million tons by 2030 materializing, if we really pull all those levers. But I think the important question here is like, what do you actually see in terms of the real demand materializing, right? What's happening now? Which sectors do you see and regions within the European Union as the lead markets? And, do you maybe have some other different perspective on techno-economic analysis models that you've just, seen in the report? Please, the floor is yours.
Thank you very much. Hello, everyone. First of all, a few words to RMI for the invitation to be here. It's a real pleasure to be here exchanging notes and sharing some thoughts. Also, a warm welcome to the report that you put out. We're broadly in line with the recommendations and the the assessment that you did to the market. And I think it's really very important that voices like yours, think tankers and researchers come forward with this reality check. It's really critical, and I really have the feeling that a huge part of my time is dedicated to inform policymakers and offtakers and the entire stakeholders around the hydrogen world about what's reality and what's just perceptions, or a vision that is grounded on a lot of optimistic and misses some solid reality from the ground. In fact, we within the organization, the Renewable Hydrogen Coalition, we don't have our internal vision set up for the expectations by 2030, but I think your predictions don't raise any red flags. In general, I think we're aligned, but clearly maybe not on the exact number will not be that, but what we can all agree here today, and I don't think it took us 5 years to come to this point, is to a common understanding that the 10 million or 10 plus 10 clearly will not be the outcome in 2030. But having said that, I don't think that the 10 plus 10 was the mistake. The 2030 was the mistake. What I'm trying to say is that that's clearly the long-term outcome. That's the right direction. We will have that amount of consumption. The misleading thing here was the calendar. The optimism was on the time to market for delivering the renewable hydrogen in this amount. So when it comes to the questions that you asked me in particular about, the sectors where we see this penetrating and the regions within Europe, so clearly the low-hanging fruits would be the industrial sectors that already consume hydrogen today as a feedstock. So not even playing on the energy policy, but really on the industrial decarbonization. So that would be, chemical industries, the fertilizer production, even potentially some in the refinery, and then new utilizations of hydrogen in heavy industrial areas like the steel production, and also for transportation, maritime and aviation. So really the hard to abate sectors. And it's really important that today we are in a situation where we can easily demystify this Swiss arm concept. And clearly hydrogen is not, a tool that serves everybody, although it's very versatile and it has its, advantage for being very versatile in terms of the utilizations and the applications, but the value for money is very different for different applications. So it's too noble of a gas to be used in applications where we have other alternatives that are more cost effective, and it could actually be a distraction if we think it's a Swiss arm tool. In terms of regions within Europe, so I think we're all aligned there as well, that Central Europe is the heavy, the hotspot for consumption. So Germany, France, the Netherlands, Belgium, that region there. And when it comes to the production, although these regions, the Central Europe is also an important region for production, I think both Northern Europe and Southern Europe, especially the Iberian Peninsula, are very well suited in terms of having access to competitive renewable resources and a good combination of, especially in the south, of wind and solar and potentially even hydro, to play with and serve more than the local consumption and export within the European borders. So serve as a supplier for internal consumption in Europe.
Great, thank you, Anna. I think next we will go to Roland to close this round. Welcome, Roland. And of course, will be super interesting to hear your global perspective from within the value chain, as you are there in the midst serving multiple project developers with different types of technologies and across different hydrogen production pathways too. So maybe you could share those perspective on challenges that you see of scaling up electrolyzer manufacturing and your experience in that regard, but also, dropping this to 3,000 feet or even 30 feet, from the view from a factory floor, as Topsoe commission is groundbreaking solid oxide electrolyzer factory in Denmark last year, and I think we saw Commissioner Hoekstra visiting it last week, I believe. How are things going? Could you give us a sense, how your order book is filling up, and the floor is yours.
Do you really have to start with the depressing part of the equation? So I think what we all see is a significant slowdown over the last 18 months plus of, and it was mentioned in the report as well, of further development of specifically green hydrogen. Even let's say the transitional alternative, blue hydrogen, although a lot of projects have come up and a few of them actually reached FID, construction is halting. Take on blue, take Dow in Alberta, Canada, that has now been stopped. Baytown, Exxon announced 18 months ago, still no FID. I'm happy to hear the 3 gigawatts, Lucas, that you mentioned under construction. I haven't seen them in Europe. I haven't seen the FIDs either. So I think the real numbers are significantly less than that. And if I see I would say in the last 18 months, not a single green hydrogen project in Europe has reached FID. One that actually did was Liquid Wind, or Flagship 1 in Sweden, where due to the ballooning cost, the sponsor Ørsted pulled the plug at the cost of $230 million. We have seen the first hydrogen bank auction in Europe, which was heralded as a success. However, at the price point at which this was concluded, there is great doubt that ever any of these products will be built, because it is just not within reach. So let me start with that from the shop floor. It doesn't look good. Doesn't mean that it can't look good. It can, and indeed a lot of that is dependent on systematic, long-term, and coherent policy making. And then you might say, well, we have that in the EU. And then I would counter that, well, we have some policies. We have maybe many policies. We have them in many places. We have lots of money in many places, very difficult to access. But more importantly is the fact that in the realization of the hydrogen market, you need to create demand. And the demand creation is hardly there. Demand creation needs a few things. Mandates, which I have to commend the Commission for these mandates. I think that is indeed the absolute bedrock of the development of the market. But then you have to give as well some incentives with it, because truly it is more expensive, because we are still in the scale up phase of these industries. So although you can say, well, if you have synthetic jet fuel at 3,500 euros per ton, it's only $30 or 30 euros on a 1,000 kilometer return ticket, which is true. Airlines are really reluctant to see that cost disadvantage versus fossil transporters. So something has to be done to either contract for differences or incentives, and indeed on the mandates have the penalties. But now you get to the real crux. So there's no real demand, which means that there is literally, you mentioned, Alexei, very correctly, the leverage of 1 to 7. the IRA for those projects that actually were appropriated had a 1 to 6. So it's in the ballpark, right? Now, if you do not have a committed offtake agreement with irrevocable offtake take or pay commitments, there's not a finance group that will finance your project, not at these prices. Funny enough, if you look at this industry, you are in that vicious circle where, yes, you can get financing for the early technologies. Yes, you can get financing at the end of the tour when everything has been proven and is throwing out cash, and you get the infra funds. In the middle, which you actually need to scale up, and you need to scale up in order to drive costs down, there's no one there. And there's even fewer there at the moment, because if you talk to the financial world, the Brookfields, etc. of this world, they will tell you that they do not believe that the Commission will stick to the deadlines and the commitments and the mandates, because there's no supply. So if there's no supply, it is not realistic to stick to it. And Anna, you said the timeline is wrong, the ambition is right. The trouble is that thinking is completely in the market, and as a result, there's no financing coming forth. The only way to make sure that is not going to hamper the market is to reiterate unequivocally that these mandates and the penalties and the timelines stand. I know that within the Commission, within the European Union, though, not every member state supports that. The other thing that will have to be very clear is that we need some sort of mechanisms to get financing capital in. For instance, in the US, they use investment guarantees, which is a relatively cheap instrument, because most of the time you don't have to pay out, because these are projects that in the end will work. That would be an instrument that can be used cheaply, but production incentives can be used as well. So that set of coherent policies is not really there, and the longevity is not there either. And I'll pause here, because I can go on for a very long time on the things that are needed to make this go. I'll just add one thing, because John, you correctly pointed at China. And you can say, well, that's all subsidized. And yes, it was. But the way they subsidized was that they mandated the SOEs to invest in very large scale projects. Sinopec had to build a 1 gigawatt facility for green hydrogen. That in itself created an enormous amount of supply chain scale up that was initially relatively subsidized as well. Meanwhile, over 60%, 65% of the world's investment in energy transition takes place in China. I think probably about 70% of all electrolyzer capacity has been built in China. And as a result, we saw recently one of the big shipping companies securing green methanol for a whopping price of $640 per ton. And to put it into perspective, I think, John, you probably know this better, but I think the Methanex quote at the moment for the US is $890. In Europe, something like 760 euros. So significantly below the cost of fossil methanol. And this is what the Commission has to understand. And I'm sorry to use such a word, because of course you are all extremely bright people. It's not the issue is not about understanding, but if you do not scale up, you will not become competitive with fossil. You cannot scale up unless the systems, regulations, mandates, and incentives are in place long-term to get it done. I'll stop here.
Thank you, Roland. And you teed it up excellently for our next round here. I will give an opportunity for Lucas to respond on the topic of carrots and sticks and mandates and demand creation in a minute. But first, maybe I would like to give a floor to John to react to this question of demand creation, really. And the question here is really lead sectors that we see as a no regrets application for hydrogen and its derivatives, and what's really needed to do that demand creation and unlock offtake agreements in these sectors that Roland talked about as a critical enabler and catalyst.
Yeah, I think, Roland, you brought some sobering, kind of thoughts to where Europe stands right now. And certainly when we look at China, it is a supply-driven, kind of approach that they've taken in order to stimulate and get to cost levels that are competitive. I think Europe is trying to wrap everything around here, and supply or demand is really the important nut to crack for Europe as we think about what's essential to drive down costs. And, as RMI, we of course think about energy efficiency and direct electrification as, kind of leaders in the decarbonization element. And you always want to do those first. But for sectors that can't be electrified, that's where renewable hydrogen has a role to play. And when we think about the context of Europe, so the Swiss Army knife, kind of metaphor that's been overly abused that Anna certainly pointed to, we need to be more focused, and we need to be more focused on, in particular, the markets of fertilizers and steel making and shipping, aviation, refining, right? These are kind of the five big ones that will move the needle here in the end, that make the most sense and that can't be electrified easily. And for Europe specifically, it's about how do you tackle those within the core industrial base of Europe in Germany, the Netherlands, Belgium, and France, right? And when we look at it, if you prioritize and think about sector-based strategies within those four countries, that's going to give you the majority of the leverage within the system here going forward. Kickstarting demand, in these sectors, in these regions, really requires strong policy support, strong public support to make this growth a reality. I think there are, certainly ways for the Commission to do this through some of the mechanisms that Roland offered through public procurement as well. I think the Commission has already pointed to the Hydrogen Bank as well as H2 Global as being two, kind of mechanisms that help stimulate demand side. I think being really clear on the RFNBO mandates to ensure that they're intact and that the market has confidence on that side, again, to stimulate and kind of certify demand is super important at this point in time. I would say as well, to get to that sevenfold leveraging of impact that we get when we get kind of investments from the public side to private scaling factors, that there is a role for voluntary demand as well. And that's maybe underplayed. We've certainly seen at RMI working with steel and the Sustainable Steel Buyers Alliance, with aviation and the Sustainable Aviation Buyers Alliance, shipping, where we have a book and claim system that we've helped set up, that there are ways for us to organize demand voluntarily that then helps, kind of inform public markets and standards and can be a useful intermediary step that gets that demand moving faster, because that's the critical unlock here as we think about the challenge for Europe right now. How do we create that strong demand signal in a limited number of sectors in key geographies?
Thank you, John. So, Lucas, that I think sets the scene very well for you to react to both what Roland and John have just pointed out to. Clearly, we have this picture the framework might be comprehensive, but not, coherent enough. And there is clearly something in there, which is about, mismatch between, set of policy tools that we are trying to use to drive this forward and, policy objectives that have been set. And therefore, the question here is really, the core engine here that has been mentioned, right? Sticks and carrots, balance between subsidies and regulated mandates that are required to move us forward. And like more specifically, if you could shed any light on ongoing process of transposition of this key renewable energy directive mandates by member states. You've mentioned that you are working very closely with member states. Whatever you can share about that process and how optimistic you are about that will happen by the end of this month will be great to hear about that.
Sure, thanks. Maybe to take a step back before replying, I think it's also very important that we're having this discussion about undoubtedly the fact that in particular renewable, but also low carbon hydrogen are still much too expensive within the overall energy transition context. And I think we can really only pull this off if we continue to massively deploy renewable energy. I think that's I think one precondition. That's also why some might like it, some like it less. We have rules in place that try to avoid that hydrogen production will be at the detriment of electrification. You referred to it before. So I think that's a key condition without which our sector will not develop the way it should. And zooming into the question and maybe responding straight away to what Roland you said, I think we are determined to make this work. We do not have an intention to soften the industry and transport targets, and we are working closely with member states on their implementation. But undoubtedly, there are challenges starting from, can we actually get the hydrogen to the factory door of industries that need it? And we are really working very hard with the member states also so that they can actually really deploy and accelerate infrastructure development. But undoubtedly, there are of course challenges that we need to tackle. Concretely, where do we stand? We have had a workshop with member states last week. As regards the transport target, we have member states that have transposed it already. That's Finland, Czech Republic, Romania, and Denmark. And we also have 3 member states that have already transposed or at least fixed their approach to the industry target, and that's Netherlands, Czech Republic, and Romania. And across the board, I think in the industry targets on the industry target side, you see generally, I would say, a mix between some target imposed on industry coupled with incentives, but undoubtedly that's much below the 42% that the Renewable Energy Directive set. So we will need to look at how far these policies will get the member states. I think the work with member states is very constructive. I mean, they really also want, at least the administrations with which we are working, they really want to make this work. We will continue discussions with them in Poland next week in discussions on the Renewable Energy Directive. And we will also then offer some further workshops as much as needed. And then when it comes to, and I was also seeing questions in the chat, when it comes to how are we actually then going to handle that, I think that's the way the Commission handles transposition of legislation. I mean, we will then look into how what's on the ground, assess the whole package of the sticks and the carrots, and see how far that can, if that complies with the rules that we want to see. And to conclude, I think I've already referred to it before. The lead markets that we want to see emerging in key sectors, I think, are a very important complement, and colleagues in our industry department are working on the rules for that. The public procurement rules that the Commission will adopt soon should also make sure that there is an incentive to actually procure CO2 poor supplies for the public sector. And finally, I think we are committed to keep regulatory certainty, but we are also open to adapt, and that's why the study that we will launch soon should, in dialogue with the sector, help us to identify if there are things that need to be fine-tuned. But we hope that we can keep the framework as stable as possible.
Thank you, Lucas. And it was encouraging to hear not only the names of Central European countries when you talked about those countries that are transposing the mandates, but also some Eastern European countries that have significant industrial potential. I think you've mentioned Romania there among those. So with that, I would like to go to Anna and ask the same question, but this time around, Anna, with your other hat on of the Chief Hydrogen Officer at EDP. If you could reflect on balance of carrots and sticks offered in Europe and member states, but also reflect more broadly. Is this framework sufficient for you as a project developer, who is, no doubt, facing some headwinds these days to move your projects forward and get them across the final investment decision line?
Sure. In fact, we have at EDP, we have several projects well advanced that I could share. They are shovel ready. I mean, we have secured land, we have environmental permitting, we have grid connection, we have gone through the procurement process, we have secured over 400 million euros of public funding for these projects. These are projects in Spain and in Portugal of 100 megawatt plus in each location. And we're still missing the firm commitment from demand. That we all talked about, and you mentioned even the framework, it's not coherent, and we can name several evidences of it not being coherent. It's a question of unbalanced carrots and sticks, because the reality is so far we have only carrots, but the carrots are not good enough to make the horse move. The reality is that it's not even that we missed the stick to design an efficient instrument, in the sense that the subsidies may be overpaying and are too expensive. We're not even there. It's that the subsidies are by design incomplete. Several member states have used the Recovery and Resilience funds to support the production side of hydrogen through grants that by design support a portion of the capex. So by design, not sufficient to close the funding gap. And then we have a hydrogen bank that also by design does not allow these projects, potentially the most advanced ones, to participate and accumulate funding to finally close the funding gap. So I think we've done some mistakes in the way we design our policy instruments, and we are at a situation where many developers like ourselves, and I could risk saying that all of us, are looking at these potential subsidies and grants and supporting instruments as options. Most of them are even almost free options. Others, like the Hydrogen Bank, they required us to put at risk some warranties, but even that we can debate if that's enough, or if we can still put that money at risk to have an option, not a commitment to deliver the project, right? And then we have a hiatus between, the calendars that we commit to deliver the projects with the granting institutions, the member states, the European Commission, CINEA for Innovation Fund, or for the Hydrogen Bank, and the visibility that offtakers have for firm commitments, which is 2030 plus. So we will end up with, 4 or 5 years time where the money will not, the money that was already allocated will not be delivered, and we all be losing this opportunity. So it will be a lost opportunity. It's not that we're wasting money. We will not be using the money itself. So because there's a hiatus also on calendars. Again, this is a rule. It's a design, a failure of the design. So we can think of different things that and try to learn from the different things that are not working and try to improve the instruments that we design going forward, namely the hydrogen bank. I'm a firm believer that the hydrogen bank has it all when in concept to be an efficient instrument and deliver what we're aiming for, but it needs some adjustments. And the reality is that even if we look at the roundtable that we have here today, we have representations from the main stakeholders of the hydrogen economy, but not a single voice from the consumption. And this is not just this roundtable here as today. It's a common place if you go to conference, forum, interactions when we discuss about hydrogen. You have the policymakers, you have the equipment manufacturers, you have the production side of it, sometimes the infrastructure, but never the demand. So the off-takers' voice is not even heard because they don't feel any rush. And even if I was, putting my feet under, on the off-takers' shoes, behaving rationally, I have no incentives today to pay a premium if I don't even have clarity on the rules that I know are coming through the transposition of the Renewable Energy Directive mainly, but other instruments potentially that will mandate me to consume hydrogen in 5-year time. So that's the rational behavior of agents in the market. And so I think we can all understand why we are at the situation that we are today. I mean, this should not surprise us that, are in this market and looking at this topic for a long time now.
Thank you, Anna. It's very clear, and I think pins down, the problem statement here. And I think, Roland, I would like next go to you and see if we can talk a bit about the solution space and how we could fix this, maybe using one specific sector that you've already mentioned, aviation. I know that you are Topsoe is part of the Sky Power Coalition, and you spend lots of time thinking about how to solve this very challenge that Anna was describing for aviation. And maybe you could share your thoughts of how the industry and policymakers, could work together here to solve this intertwined demand creation, scale, cost, challenge, and build confidence in the market, because I don't think that we have a luxury of time here and can lose 4-5 years, as Anna has just mentioned, which is a real risk, and that will have, a really detrimental and knock-on effect on the whole industry if that would be the case. So maybe you could share some thoughts here, Roland, on aviation, if you like to focus on that sector.
Yeah, I think it's indeed it's the one sector where you can easily say there is no alternative if you want to decarbonize it, other than ideally non-bio synthetic fuel. I think generally speaking, the way it has been set up with a mandate that first of all is for sustainable aviation fuel with a definitive part has to be synthetic, and then by 2030, and then the growing very rapidly, especially the synthetic part going to 2040. I think that structure is excellent, and I really mean that. The fact that there is a connection specifically directly on the ESAF and penalties that are very large is another one that should be that's turning the carrot into a stick, which is fine. That works. To Anna's point, what you see is that the customers, the airlines, are not really very worried, nor are they very concerned or getting very nervous, because strangely enough, the responsibility to actually meet these mandates lies with the fuel supplier and not with the airline. So that in my view, is probably an oversight in the thinking. But that's one thing. The other end is again, some things do work. Under the Innovation Fund, the Commission has stretched the state aid rules a bit, and we see that, for instance, we are not only suppliers of technology, we also are with Sasol, the proud owners of Zafra, which is a developer for specifically ESAF projects. We see that some member countries are very keen to support this and to put money on the production side. Again, what it is missing is indeed the demand creation. The biggest on this, and you said, by the way, I can take shipping together with aviation because they're very similar. The biggest argument, both by the shippers and by the airlines, is we have such thin margins that a small increase in our fuel cost will make us less competitive, and as a result, then we as European shippers will, or airlines, will be at a significant disadvantage to the internationals. So how to bridge that? I think, Anna, you're right. It is on infrastructure investments, it probably works to have incentives that make you cross the hurdle. We have done that with our electrolyzer facility. It's a new technology, first of its kind, 35% higher efficiency than existing technologies. We built a 300 million euro factory, but we only could do that because the Commission granted us 94 million euros. That took enough of the risk off for us to build this. That doesn't work on the demand side. If you say, well, we'll take 10%, 15% of that price difference off, then the airline still will say, oh, that still doesn't help me in my competitiveness. So you still do not get to the point where they will voluntarily take the demand, or where the finance world will say, okay, there is irrevocable offtake. So I think, Anna, you're right. You have to really initially go for contracts for difference to basically cover the whole penalty. And then you can say, and then it's up to industry to make sure that you can, for instance, phase them out over 15 years. Putting pressure on industry to get the scaling and the cost effectiveness, but you need to kickstart it.
That's great. Thank you, Roland and Anna. I think we digged into the solution space quite a bit here. We have 7 minutes left. Unfortunately, time flies, so we don't have time for yet another round or addressing questions from the audience. But I would really like to give everyone an opportunity to flag, for 1 minute, one concrete kind of pragmatic step of how we could take this forward. Based on what we've just discussed, what do you see as one step that will allow us to have that recalibrated effort to move the hydrogen strategy in the EU forward? Maybe starting with you, Lucas, as you were patiently making notes. You might be muted.
Maybe I should start by saying we are actually considering to update the European hydrogen strategy. We plan to do that next year. Details still to be defined, but we will of course reach out to the sector and discuss with all, feed in what we learned through the study that's kicking off now. So that's maybe the most concrete thing, to recalibrate it, to actually say we will do it. But seriously, I think on our side, what we need to do is still deliver the framework. We still want to adopt the Low Carbon Delegated Act in the next weeks if we can. And then more broadly, and picking up on what Anna and Roland have said, I'm listening very carefully to that. And we really want this to work. And I mean, we've had many discussions with colleagues inside the Commission also. There are always good reasons why things are in a certain way, you know. But I think I'm very interested in sort of continuing this dialogue and really seeing also how can we in the future maybe think about guarantees or other possibilities that maybe don't require so much cash in times of stretched budgets to actually make the sector take off a bit quicker. Thanks.
Absolutely. Thanks, Lucas. John, maybe going next to you, your reflections.
Yeah, it is a tough job here for Lucas, but I think the Commission has a big challenge here. There is a need, you know, just to practically reset what the goal is for 2030 and then work toward that. Really focus on the hard to electrify sectors. Make sure that the carrots and sticks that are in line are both edible and palpable. I think, but most importantly that the demand doesn't fall by the wayside here as being the important driver in the long term, recognizing that even in a scarce environment of funding that there is high leverage and to target, you know, specifically in those hard to electrify sectors in the right places. And then, you know, everything that you can do on the stability front is going to help Anna and Roland and the rest of the industry really build here. But I'll turn it over to our two industry participants here for their thoughts.
Exactly. Anna, would you like to go first?
Sure, although it's very difficult to add something at this point because I think we said it all. If we're not entering into a lot of details, clearly we don't have time to do that, and that's not the objective of today's conversation. But so going forward, really, I think we should now put our efforts towards unlocking the demand. We've been mainly focused on unlocking the production and supporting the production. We really now need really to gear our efforts towards the demand, prioritizing and clearly making sure that we design policy tools aligned with the policy objectives. So complete and efficient in closing the funding gap and in aligning calendars. Long-term visibility and stability of the policy, I think John mentioned it a couple of times. It's really critical not to jeopardize the confidence of investors. So we have not yet, even really started this renewable hydrogen economy. So it's a bit dangerous to start thinking of reshaping it or reassessing it if it hasn't started yet. So long-term visibility is really, really important and this stability going forward.
Thank you, Anna. And Roland, maybe over to you to crystallize your thoughts in a few sentences.
Yeah, very short, 3 points. First, stick to guidelines and goals and make it abundantly clear that nothing can move that to the outside world. Secondly, continue the public-private dialogue that has started already under von der Leyen 1 and is continuing at the moment and actually is excellent and really has a great impact. But let's add more of the demand side to that. And then thirdly, manage it as a business. One of the things is, generally speaking, governments set a target 5 years out, and then they congratulate themselves on having the target, take COP28 and tripling the renewable energy, and then they sit back and wait what happens, rather than actually monitor the development and then take corrective action early rather than too late.
Very clear. Thank you, Roland. And with that, I would like to thank all the panelists. I think that was great. I thoroughly enjoyed this discussion, but also felt that we digged into a solution space and had a very real conversation about what the problems are to tackle. And while the challenges are significant ahead of us, I do believe overall positive about European hydrogen strategy and where we can get with it by 2030 if we take all the necessary steps that we've discussed today. So With that, I would like also to thank everyone who has joined us today for this webinar on recalibrating Europe's hydrogen strategy. We were excited to share our important work with you, but also the thoughts of the panelists who discussed the set of important topics today. We've been recording this session, and the recording will be posted on the event page, the same that you used to register for the webinar within 24 hours. The QR code on the screen will take you straight to that event page. With that, I would like to thank everyone once again and wish you to have a productive rest of the day. Thank you very much.
Thank you very much.
Thank you.
Thank you.